Hi, everyone. I'm Jen, your host of Blockchain Banter, and welcome to Mastering the Market Trading Crypto. I'm here with Keith Allen, TA and Algo Trader, Orderbook Analyst, and co founder of Material Indicators, along with Dr. Mark Richardson, Project Lead at Bancor and creator of Carbon DeFi. Thank you guys so much for joining me, and thank you to all of our audience as well for tuning in. Um, Kind of a wild ride in the market right now. I know you guys have been calling for, I'm waiting for it, have your dry powder ready. We're seeing a little bit of that right now. Keith, maybe you wouldn't mind starting us off, sharing your screen, if you would, telling us a little bit about material indicators for those that aren't familiar and what you're able to do with it and what you're seeing on your end.
Okay, let's see what we have here. Oh, I got to share the screen. So I'm trying to get all my screens in order here. I'm loving the new format, by the way. Loving the new format. Just have to figure out how to master all the buttons. Let's share. Let's share this guy.
Mark,
Right.
keep this all in mind too. I know that you're always watching what Keith is doing, but I'm going to want you to walk us through Carbon DeFi and creating a strategy, you know, kind of with the material that Keith is going to give us, the information he's going to give us. I want to see how we can go and create a strategy on chain. So
Okay, I'm sharing the screen, but I think you have to accept it,
I
Jen.
do have to accept it. Yes, sir.
She's very powerful. But you knew this, Mark. All right, so we picked a really good day to do this, right? This is obviously a big day of volatility, and it really started here a few days ago. Oh, look, we just got some buying. Of course, now that I sold, we'll have some buying start, right? Look, just this is happening in real time, by the way, guys. So we're seeing this as it's unfolding. Um, I did an analysis earlier this morning, and we saw this liquidity here at the 60K range get rugged. That was really a total of about 40 million in this level that got pulled. So there's still about 30 million, 33 million still there at the moment, but I don't have a lot of confidence in it holding. Now we're seeing a brand new order from these mega whales. Those aren't the ones I watch the most. It's very telling that I just want to see how big this order was real quickly. Um, that was about $6 million. So pretty sizable actually for them. Um, we've been talking about this breakdown happening for a long time, and if this has taught me anything, it's patience. Sometimes you just got to be patient. And a lot of us who are day traders, especially, are always looking for that opportunity to make a trade because that's how we make money. And, you can find yourself exposed to a situation like this where you're getting hurt. So you always have to be cautious, especially when we're saying the market feels toppy, the market feels toppy. Well, we've been saying that for months and months and months, and the market has continued to climb. And so, rather than sit there sidelined, and a lot of people have done that, and hey, you do what works for you for the way that you like to trade. But for me, I'm always looking for opportunities. So I was building a position, and then we saw this dump over the weekend, and we got a red weekly close, and you know that's when I decided I wanted to maybe sell some of what I had picked up over the past 2 weeks or so, because it was all at a higher level, and maybe repurpose that into an order at a lower level, and hopefully improve my cost basis. That's playing out right now. The question is, where do we go from here, right? So this still is only a 15% move. We've been calling for 20, 30, 40% potentially to happen. And so, as of yesterday, even as of this morning, when we had this bid support sitting here at 60K, it was like, well, 60K isn't really a great technical level. Yes, we have some history in that 58 to 60K range, as we can see here. but it just it this time around we ripped through it really quickly. Okay, there was really no resistance on this run up. However, in the prior run up, in the prior all-time high, this was an area of confluence here in this 58 to 60K range. So yes, that's a viable target, but it's kind of a half-baked correction, if you ask me at this point. And when I saw this rug pull this morning, it made me think that, hey, maybe there's potentially more downside coming. When that comes, we could conceivably bounce here, right? And when you see a big whale order like this, that's encouraging. But where I want to see the buying begin is out of the purple class, because they're the ones that have historically dominated. And quite frankly, this red class of sharks has been really leading the charge in volume since Christmas. And the fact that they're selling right now, typically they're the first ones to start buying back in, and they haven't done so yet. Now, a bit of a concern that we're not seeing really much volume down below the 60K level. This just rugged literally, an hour or so ago. And so maybe 2 hours ago. But, as price approaches, we start to see liquidity move with it, right? So we are seeing a ladder down in that direction, but it's not huge. So I want to see concentrations like we had here, right? When we had big six-figure levels of concentrated bid liquidity, and some depth to it. This range here was like, a $200 million, $250 million stack. And if you remember at the time, Mark, we were discussing pullbacks, and I said, this is the kind of concentration of liquidity that we look for to see bigger moves, and we got it, right? So these straight lines right here, these are the ones that concern me. These are the ones that I expect to retrace, at least to some degree. And we had another one here, and we've essentially, at this point, we're retracing much of this move here. So where do we go from here, right? I look to areas of prior consolidation. Obviously, we still have some liquidity here holding things up for the moment. We have an FOMC announcement coming up tomorrow, which maybe this will be a guardrail holding things in place until we get that announcement. In that regard, Fed Chair Powell the guy does not like to surprise the market, right? He telegraphs what their intentions are, and he's done that throughout the entire process. And at this point, as recently as the last, a few weeks ago when he testified in front of Congress, he said, we anticipate, 75 basis points, cuts this year. It would be a series of 3 quarter-point cuts. We're just not sure when we're going to start that. Things are trending in the right direction. We expect it to be a bumpy ride down, but we want more data. And we're hitting some of those bumps right now. The last week's inflation reports came out hotter than expected. And so the market started selling. That was on a Thursday. The market started selling. Friday, the ETF, the net ETF inflows started declining. Yesterday, we had a net negative in ETF flow. So this kind of paves the way for this to be happening right at this moment. And tomorrow, Powell's going to say, I don't think much of the market is expecting a rate hike or a cut tomorrow. Although somebody in my Twitter feed said, definitely a rate hike tomorrow. Probably not. My expectation is he is going to, he's going to walk the line the way that he always does. But we're listening to hear if he's hawkish or dovish. We're listening to hear if he still feels, if the FOMC still feels like there is a potential for 3 cuts for a total of 75 basis points for the remainder of the year. So if that starts in the next quarter, that's fine. If it starts even in third quarter, the market would not care as long as they're getting their 75 basis points for the year. That's going to be baked in. So, I think whatever happens tomorrow based on his comments could be near-term volatility and then the market's going to do what it does. So if he says, hey, we're on for 75 basis points and we're going to start, next quarter, he's never given us a definitive date of when they're going to do anything. So I don't expect that to happen now. At this point, it's, is he still somewhat dovish? And that's not good. I gotta log back in. So give me a moment for that, and I will. All of this action on the exchanges has really, I don't know about you, but like even my trading view was hanging up this morning. My my 3 commas was taking a really long time to load, and I lost my connection here, even though my internet provider told me yesterday that they've increased my speed. All right, I think I'm back. I think I have that back on. So look, they just ate through this resistance right here. So maybe we'll get a run up. With the fact that this liquidity has been cleared out, this paves the way for volatility around tomorrow's announcement. And we see this kind of move happen a lot. So be aware of that. We're now seeing purple and red just starting to inch in a little bit, but not a lot. So I'm not overly encouraged by this just yet until I see some real volume happening. I think the bigger story is that over the week, this red class has sold. Okay, this is the normalized view. So this was the max that they had purchased during that week, over the last 7 days, and now they've sold over 60% of that, about 64% of that at this point. So that's notable, and it certainly correlates with, I've been speculating that is related to the ETF market, whether it's one of the institutions that own the ETFs, or whether it is just somebody, whether it's someone like Saylor, whether it's a sovereign entity that's accumulating, or somebody that just believes that that ETF is going to drive prices higher. Right now, they also feel like price is going to go lower. They look for an opportunity to do that, as do I. And, we talk about levels. The levels that I'm looking at are still those same levels of consolidation that we've seen historically. Right now, we're flirting with this 58 to 60K range. Maybe we go down to that 50 to 52K range, or maybe if we're lucky, this is where I'd really like to see us. That's the 21-week moving average. This would be the 40% that we've been looking for. All right. So if we got into this 60, if we got 60K, that's the 20%. All right. And Mark, I don't know, does that satisfy the market's desire for this correction? Is 20% going to be enough? Is it going to be 30% gets us to that 52K level, and 40% gets us down to this 45K level, 44, 45, where, this to me is the best foundation for the real move up, right? So we got to get back to where we're printing candles above this prior all-time high. Again, the rejection came from all of these failed attempts. Wicks below, one full candle body above, wick below, breakdown, failure to break back up, failure, and now losing the 21-day. I want that 21 week so bad. Oh my God. I've got buddies that sold 73. More power to them. I waited for the conservative move and waited for the validation of that breakdown, and I sold up here before we broke all the way down. But at this point, anything I add is an improvement on my cost basis, because I sold up here in the 67s, and so if I could replace 67 with something in the mid 40s or even low 50s, that's quite an improvement on my cost basis of the sats that I'm holding.
Thanks so much, Keith. As you maneuver and try to make your way around, so am I. So I forgot I was muted. Sorry about that. Thank you. Thank you for walking us through all of that. It really is interesting to see how much you can gather from analyzing the order books. Mark, I want to turn it over to you for a minute because, as Keith is saying, we are looking at these ranges, right? And I kind of want to play a little bit. Keith, I know that you are more centralized exchange, right?
Mhm.
Um, Mark, Carbon DeFi is obviously on chain. This is a decentralized exchange. How can someone create these sort of ranges or trade these sort of ranges on chain? Maybe you can give us a little bit about Carbon DeFi and what users can do to achieve the same sort of things that Keith is achieving off chain.
Yeah. I just attempted to share my screen. Did that work as expected?
I
Perfect.
see a whole lot of
Yeah.
us. There we go.
Good enough. Yeah, so let's quickly speak about what I think Keith is observing, and certainly what Keith and I have been I don't want to say necessarily asking for, but let's say that what we've been anticipating for a little while, just because it seems to be what happens during bull markets. So, for example, if we come back here, you can see that this is something that Keith has spoken about at length, is that even during an uptrend, and this is a very, very strong uptrend, beginning from June of 2016 up to December of 2017, you can, there are a few sort of things that you want to note. One is that, these, even during these, ridiculous market runs, these drawdowns are still relatively large, right? Like it doesn't look like it looking back here, but from the local peak on June of 2017 down to the local bottom in August of 2017, that was a 42% drawdown. And you can see that this has happened, quite a lot during this run. This is a 35% drawdown here. You can see this is a 39% drawdown, and so on. This happens all the time. And so this is, a few weeks ago when I said that, Bitcoin eats a 30% drawdown for breakfast, even during a bull run. This is what I'm talking about. And this is kind of old. There wasn't a huge amount of market structure back here. But if we have a look sort of more recently, if we're looking at more recent history to sort of get an idea for how the Bitcoin chart behaves. One of the things I want you to note is that when we have sort of confirmed an uptrend, and I would say that this COVID crash was kind of, in a way, the beginning of that bull market phase. When we started to break above these slower moving averages, it then used these, what some people refer to as the moving average ribbons as support. And so, you'll often hear me talk about technical support levels. And I tend to do this without necessarily referring to EMAs and SMAs, but I do use them for, as a sort of confirmation as to whether or not a level is sane. And so what you can see is that during the last bull market, even with these, these very strong uptrends, there were these pullbacks, and these pullbacks tended to either check the 20 SMA and EMA closes, or it would test the 50 EMA and SMA closes. And it never really came back to test these slower ones at 200 or 100 until it was too late. And after, eventually kind of broke down under these, and that kind of confirmed the bear market phase. But now we are all the way over here. And you can see that we've got a very similar pattern. So we began below these slower moving averages on the 200, and after we sort of broke above this and fanned these things out, that it's now held the fastest moving average support. It has broken back against it, coming all the way back to the 100 EMA, but then broke above it again and is now holding the 20 EMA and SMA as support. Now we've broken below this, And this isn't necessarily an indication of a reversal or anything. Obviously, you can see that we did this back here in January as well, so it's not too big a deal. But it does suggest that the price targets to the downside are sort of where these lines are, not necessarily today, but wherever they're going to be, depending on how fast the price moves down.
It's a moving target.
So exactly. And so this is the kind of thing that you can come back and keep updating. But I do think it's a really good sanity check, especially because, I do think that the confluence level between the 100 EMA and the 100 SMA are actually pretty good at the moment. So this is that sweet spot between sort of around about 56.1 and 58.6. You can see that corresponds really well with this channel back here that we had right after forming the top at the peak of the last run. So that's all of this trading action that we had back here, and that's kind of where we're hovering right now. So I would expect that coming back to at least try these levels is something that the market is going to intrinsically want to attempt. And so let's just quickly draw some horizontal rays here so that we can get a good idea of what this is going to look like when we start setting it up on Carbon to trade these channels automatically for us. Let's do a line. Okay. So all I'm doing here is sort of marking out where these averages are. And I'm going to do a couple of different things because I think that there's going to be various levels of let's say ambition that we have, because it's not without reason that we will come back to test this 40 to 44 level either. So let's just mark out all of these. And what these are going to represent are essentially the error bars on where we think the price is going. Because, as much as I might like to, it's impossible to call, whether, even if I had 100% confidence that the market will continue down, I have no idea where it's going to stop, because it could find a lot of support back at these 100 EMA and SMA levels. It could take back at the 50. It could take a little longer and have to wait for these 100s or wait for these 200s. So, why make the choice? I think it's generally a bad idea to commit everything to sort of a single bet. And certainly you never want to, bet the house on the Bitcoin markets. And so what we're going to do instead is to ask ourselves the question, right? If this was a move that I thought was going to happen, what would be a way that I could profit from a move like this? And so we're going to assume that the bull market is going to continue to trend higher up, and instead we're just looking for the best buying opportunities, right? The best entries that we can possibly get. So between this level at about 58,914 and 58,677, I think is not too bad. And my confidence would be sort of higher. So if I was distributing cash around, let's say that I might put, maybe 60% of my cash at this level, because I'm relatively certain that after it finds support here, it will bounce and continue higher, just as it did, earlier this year, back in January. This is exactly the support level it was looking for. I suspect that the market is going to do that for us again. But it is. My mistake. Those support levels are the ones that were being checked back here, and the ones that it sort of bounced off of back here. These deeper levels are still possible though, and so if this is 60% of our cash up here, we don't want to spend everything at these levels when we can buy it significantly lower. And remember, this is significantly lower. The difference between these two targets is 11%. Which can make a very big difference to how profitable you're trading. So if we've got 60% of our cash up here, let's say that we've got 40 left. Let's do 35 in this region, and then our most optimistic targets would be sort of 5% down here, which from where we are today is sort of that 30%. Going as low as sort of 35%, which again, if you had a look at the, what Bitcoin has done previously, even in a bull market, those numbers are just not ridiculous, and so if I'm, on the balance of probabilities, I would have rather not spend all of my money at much higher price levels, when I think that if I had held out for a little longer, I could have picked up either a lot more Bitcoin or the same number of Bitcoin at a better price.
Plus,
So
in terms of DCAing, if you're essentially, dollar cost averaging your way into a position there, holding more for the lower levels is going to help you drag your cost basis down.
Exactly right. Exactly right.
But if it never hits there, then you're screwed. So you gotta so that that's the conundrum we all face as traders, right?
Absolutely. And I think that this is the the only way to beat the market is to know the future, And so if you don't know the future, you're going to have to hedge your bets a little, and this is what this is why having mixed price targets, I think, is useful. So let's
Yes.
think about how this would translate into a let's just say a buying strategy. So on a conventional exchange, if we wanted to spread our cash out, right? Either we could treat these as discrete price targets, which again I think is not the best bet, because there's still a lot of room in the middle here to sort of fan things out. So we might put a discrete limit order at each boundary of our prediction, and maybe one in the middle. But even then, what if the price comes down just to our first limit order and then moves up again? Then, or if it gets somewhere between these first two but never gets to our second one, we might have wished that we had bought a little bit more before the price reversed away. And so maybe we'll set 5 limit orders by spreading these things out, and then sort of calculating exactly which prices we want to put in here and how much cash we dedicate to each range, such that if it clears the range, we get the sort of the average price that we were expecting. Imagine doing this continuously, right? So rather than having just 5 limit orders spread where our cash is spread out throughout this range, or even 10 or 20 or 200, but an infinite number of limit orders all the way through, a continuous summation of the prices of Bitcoin. This is exactly how Carbon DeFi works. And so what we're going to do is we're going to use this range order functionality. And we're going to refer to the levels that we identified here. Give me a second to delete some of these levels. And we're going to look at just the boundaries, right? So from 58,914 is where we want to the maximum price that we're hoping to pay. So 58,914. And what's happened here? There we are. And then the bottom price is going to be 56,252, something like that. 56. But this is the effective range that we're going to be buying on, and then we would put whatever USDT that we want to commit to this strategy. Let's just say 1, 2, 3, 4, 5. And so what's going to happen is it's going to be placing, all of those bids infinitely over this range, or quasi-infinitely. It's going to be basically buying one sat at each different price point until so that after we add all of these things up, it will total the amount that our range is worth. And I think that this is a very useful thing.
So will it buy it,
because
Mark, real quick? Will it buy in both directions? Because so let's just say, for argument's sake, that you're spreading $1,000 between those boundaries, and it's going to
right,
buy all the way down. As
correct.
it goes back up within that boundary, within your buy boundary, will it continue to buy its way back up, or it's only going to buy on the way down?
Only buys on the way down. So
Okay,
you can think of it just like it's literally bids, right? So
right.
as your bidding liquidity is taken, it's those prices have gone, and this is important for a couple of reasons. One is that if the market is moving down, and you are anticipating that move, you want to make sure that as your bids are taken, that the system isn't sort of taking liberties of readjusting your bids for you if you didn't want it to. So it really is just a way to enumerate to enumerate bidding prices in the most convenient way possible. It's not it's not taking any initiative other than what you tell it to do.
Okay, so I mean, we're scaling our way in and scaling our way out, right?
Well, we
So,
could in this particular case, all we've done is to scale in.
right,
And this is because we're only putting up bidding liquidity, and so this would be creating essentially a hodl position, and we can come back and adjust this strategy later.
right. If we want to
But
sell,
one
so
of
this is how this is a way to accumulate in the range of
correct.
possibilities, because picking the exact target is freaking hard.
Exactly. And then you're hodling, right? Now you've got your Bitcoin, you've bought it at the range that you wanted to. But if we were trying to scalp a move like this, right? If we weren't actually interested in holding on to that Bitcoin, and this is a totally legitimate thing to do, especially if you're trying to get in and out
Hmm.
of a position just for some quick cash. One of the things that we might do is say, well, you know what? The difference between these slower moving averages and the faster ones is still like 20%, which wouldn't be is nothing to scoff at, especially if you are anticipating that it will find support here, just as it did back in January. And so if you wanted to put some cash down and then sell it again, during the bounce back up, especially if this is going to be a dead cat bounce, which let's assume that it's not, and that we actually do have a future bull market in front of us. But it's absolutely not outside of the question that there's actually going to be a much stronger downtrend before the market can continue further. And so if that was our expectation, if we thought that maybe we were going to come back to check the 200 EMA and SMA, what would we do? Because I would still expect the price to bounce here at the 100 SMA and EMA level. So let's choose that price target to buy our Bitcoin, and then we're going to set up the system to sell it automatically after we've bought it within a completely different price range, which is going to be the 50 SMA and EMA close. So in this particular case, we're going to be buying between 51,837. So let's do that. So we're going to be, we're going to be buying, 51,837. And down to 49,569. And we could put some amount of USDT in here, whatever we want. In this case, apparently $124 million. Let's do something a little bit more reasonable. 12,000-ish. Okay.
What's a little more reasonable than 124 million?
Oh, maybe CZ is scalping it. I don't know. Okay, so that is now telling the system that it wants to spread, that we are asking it to spread our bidding liquidity continuous, right, as a continuous summation over all of the price bounds between these two levels. And then what we're going to be doing is we're going to be placing future limit orders, right, with BTC that we don't even have yet. And we're going to be putting that, putting our asks between 58,914, and that was our maximum. And down to 56,252.
You got a question, Keith?
Yeah, I do, because I realize you're working with a paper trading account, so that's why there's 124 million when we all know that you have way more money than that, Mark. But
it's telling me I don't have a sufficient balance.
But my question is, and this is really the discussion between centralized exchanges and trading DeFi like this. So where, let's say you did have a large sum, and I know in a centralized exchange, I'm looking at the liquidity. I know what's there. I know that I need to keep my orders within a range so that I'm not creating slippage and shooting the market in either direction. If you have an offset like that on a platform in DeFi, how are you? How do you know what kind of liquidity you have to work with? And at any given moment, and likewise on the centralized exchange, I know what my fees are on every single trade. Whereas if you're spreading those orders across different exchanges or different DeFi protocols, how are you managing what your fees are? How do you know what your fees are across the board?
Right. So the so on Carbon DeFi, there are no trading fees. So this could trade. It could bounce between these ranges hundreds of thousands of times, right? Let's just imagine a situation where we end up doing something like this forever, and my bids are being taken left, right, and center. And then it moves back into my asks and takes all of those back into my bids and so on. So this could trade a trillion times, and you would never pay a fee for it.
How is that possible?
And because it's the taker that pays the fee. So every smart contract interaction requires what's called gas units. And so this is essentially the network computation overhead cost. And so when I'm setting up this strategy for the first time, it is going to, like, the network is going to demand a fee from me. So the Ethereum validators need to be paid, and they're going to run a complex computation for you. And so you need to pay them some ETH in order to do that computational work for you. But after it's set up, that's it. All of these trades.
So when you just to clarify, so when you set your range, okay, let's just say you set those 3 ranges of buy orders. You would then, would each individual range come with its own set of fees, or is it all going to be in one, as one, applied to one strategy? That's the first question. And so then you're basically paying to run the strategy, for example, in theory, right?
Yeah. So the
and what do those fees look like?
You're mostly paying to publish it, which is the gas cost of the chain. And Carbon DeFi is, it's deployed on Ethereum mainnet, and sometimes it can be a little expensive if the network is congested. It's still, it's cheap compared to other similar protocols, but probably, expensive compared to using Binance and Coinbase and that kind of thing. But the protocol is also deployed on the scaling up solutions that Ethereum has built on top of it, called the layer 2s. And there it's practically free, especially now after the Dancun upgrade and the fact that we now have transient storage. So the gas fees on things like Base, on Optimism, on Arbitrum are now Phantom. Well, Phantom's not a layer 2, right? Phantom
Not
is
in the
its own.
upgrade, but the deployment.
Yeah. But yeah, the fees there are like a fraction of a cent. If you put down, if you wanted to trade a strategy like this with $100 billion, you would still only pay a fraction of a cent in fees. And then the people who trade with you. So the way that the system is monetized is that the taker pays a small fee when they interact with your position, but the person who owns that position never pays a fee. So if you're asking for to clear your order at at $59,000, you will get exactly $59,000. There is no fee other than the gas fee that you pay
So the
front.
fees are not relative to the size of your orders, which is obviously different in a centralized exchange. You're paying relative to your volume. And
Yeah.
if
So
I understand this correctly, you're just paying that gas fee to publish this strategy, regardless of whether you're working with $100, $1,000, or $100 million.
Correct.
Same fee.
So yeah, same fee. Exactly right. And this is why Ethereum has become kind of a whale chain, because what you're paying for in terms of the gas is the computation cost, and it costs just as much electricity to calculate 100 divided by 8 as it does 100 billion divided by 800 billion. And so the gas cost is the same. It doesn't really care or even know how much money you're playing with, because the tokens are the tokens all look alike to the EVM. All it knows is what numbers, and what operations actually need to be performed in order for that strategy to be published. And so that's why the fee is consistent regardless of how much money it's actually worth. And then when the actual market is interacting with you, the fee then is like I said, it's on the trading side. So this is a markup monetization, similar to how if someone was to put their product on the shelf at Walmart or something like that, they might say this product to me is worth $100, and so I want to sell it to Walmart's customers for $100, and then Walmart will say, okay, it's $100.10. And that will be Walmart's markup. It's a similar situation here. So the reported prices are usually about 20 bips higher than what the maker stipulated, and that 20 bips goes back towards the protocol, and that's part of the business model for running it. But in terms of trading efficiency, like I said, these things can trade in an enormous number of times, and the fees that you save from not interacting with a centralized order book can generally clear that overhead pretty quickly, especially if you're trading with relatively small amounts on something like Base, where Binance tends to set up their fee packages in such a way that much larger volumes are rewarded compared to smaller ones.
Right.
And so you would actually you would be paying quite a bit in fees if you were to trade that many times. But yeah, Carbon is set up, for complete automation, and that if that means it has to trade 100 million times, it will trade 100 million times, and it will never pay a fee for doing that.
That's cool. Very interesting. And how many different platforms or protocols are you pooling from in terms of
The entire chain.
So you're looking for liquidity. One may
Yeah.
not have it all. Where's it come from?
Yeah, that's exactly right. So the Carbon is it's still a decentralized exchange, but the liquidity that's used to fill orders comes from several different places. One is that it can come directly from takers, so people can go and have a look at the prices that you're asking and decide whether or not to trade with you that way. But in general, and this is true of pretty much all liquidity protocols, the liquidity comes from the chain itself. So even if even if the protocol that you're interacting with doesn't have like the deepest liquidity in the world, it really doesn't matter, because the entirety of Ethereum actually has quite a lot of liquidity for things like WBTC and USDT, for example. So on Carbon, if you set up an order to trade this way, it's sourcing liquidity from Binance, through the arbitrage network. It's sourcing liquidity from SushiSwap, from Uniswap. It's even sourcing liquidity from lending protocols in from some instances. There's you're basically trading against the entire blockchain, not any one specific product. So the liquidity is very, very deep, comparable, if not better, than most centralized exchanges.
That's good to know. And I would expect that liquidity, over time, starts to improve, especially with with the more popular platforms, protocols.
Yeah, and just like we spoke about on this call previously, there was a time where the on-chain liquidity was starting to look relatively thin on the ground, but it was also starting to look relatively thin on the ground on Binance, but it was the on-chain marketplace was hurt, or at least felt that pain a little bit more significantly than I think the decentralized marketplaces did. But that's significantly improved. Now we're seeing a lot more users come back to Ethereum and use its products, as well as the layer 2s that are built on top of it. And as Jen mentioned, competing layer 1s, things like Phantom and Solana and Avalanche and so on. I think part of that is motivated by, and I'm not sure if you saw this, Keith, but Gemini started to halt withdrawals on BTC just I think a couple of weeks ago. And whenever this happens, and it happens like clockwork, I feel like every couple of months, one of these centralized exchanges has underestimated how much of a token it needs to actually keep on the book to allow people to withdraw. And while they're either participating in OTC stuff, or trying to borrow some money to make sure that users are actually properly collateralized, they generally pause system withdrawals, and this makes people nervous, as it should. And so whenever something like that happens, it tends to precipitate a lot more on-chain activity as people start to lose confidence in the exchanges that they're using.
You know what? On that note, I read some posts yesterday about USDT being halted on an exchange, or maybe
Right.
in Europe. Is there, and I haven't had time to go check the validity of that. I don't own any USDT. I don't hold it. I've been skeptical of that one for years. Have you seen any of that?
Yeah, I mean, I do use USDT, but I only use it on chain. I generally don't use any centralized exchanges for much of anything anymore. But yeah, USDT is an interesting one, because if you are if you're a criminal, it's still possible for Tether to freeze assets in your wallet. Like it's a permissioned token. And this is something that people have been aware of for a very long time. It was one of the biggest criticisms brought against USDT. And even things like USDC also have that functionality built into it. And this is at least partly why the stablecoin DAI became so popular, because it's a 100% permissionless token, and the fact that Bitfinex can't send a command to the blockchain to stop you from using your DAI makes people feel a lot better. But
But your
I have
lead into
seen.
this is the problem. Your lead into this was, if you're a criminal, then they can do this. And
Yeah, exactly. And so if you're
so,
not a criminal, yeah, no one's paying attention. Like no one really cares. Like it's not that the Ethereum blockchain doesn't like run out of USDT. It's a deterministic system. If you're supposed to have XYZ amount of USDT in your wallet, then XYZ USDT your wallet will have. There is no ability to over-report or under-report. it is a state machine. So you will always have exactly what you think you have. You're not relying on, Binance crossing its heart, pinky promising that it actually has the USDT available that it says that it owes you. And that again makes people feel a lot better. And if you're not committing crimes, and if you're not hacking people and that sort of thing, then that USDT is going to be available to you all the time. And that is that peace of mind matters
unless
to
of course
people
the
that are
exchange
trading
gets
those
hacked.
size. Yeah, well, yeah, I mean that's certainly a problem. So yeah, the smart contract risk is absolutely something that matters, and this is why third party audits and things are so important.
I was just reminded of that fact this week when I got an email from Cryptopia. If anybody remembers that one, um, back in 2018, 2019, in the early days, you had to be on multiple exchanges if you wanted to trade alts because
Right.
nothing really had a lot. And then Binance came along and there was, and obviously they have the most, now like over 400 BTC pairs, 400 ETH pairs. But back then you had to be on multiple exchanges. And I had a client that was paying me in their coin as they did back in those days, and as we accepted back in those days before we got wise. And so I was on Cryptopia, and they were paying me in their coin, and they were paying me in Bitcoin. And when they got hacked, the exchange froze everything. So that account has been frozen for years and years and years. And I wrote it off as a loss, took my lumps, and moved on. And this week I was reminded that I did have Bitcoin in that account, and that's when it was $3,800. And so
Wow.
I still don't have that Bitcoin, but man, if I get it back someday, it's going to be a gift.
Yeah, it's worth pointing out as well,
Fingers
because I think
crossed.
that fingers crossed. What you've drawn attention to, I think, is something that is often overlooked, which is that it's almost a cliche, I think, at this stage for people to say, I refuse to use like any on-chain products because they get hacked all the time, or there's so much smart contract risk and things. And I'm not saying that those fears are illegitimate or anything like that, but to turn around and say that's why I use such and such a service, and then rattle off some whatever the hottest centralized exchange is for the time. The number of centralized exchange hacks are also pretty profound, and it's I think it's important for just to acknowledge, that we spend a lot of time talking about trading crypto and risk management and that kind of thing. And being exposed to like one exchange is also in a way is a bad type of risk management. I think that with things like Binance and Coinbase, the risk is pretty low, but it's never zero. And there was a time where people would have thought that, Mount Gox has all of the momentum in the world, nothing can stop it. I mean, there were times when people thought, Lehman Brothers was going to be around forever and so on. Like these black swan events happen.
Right.
And I'm not
And the
saying
count
that,
and
yeah,
you mentioned Lehman Brothers, traditional finance, the counterparty risks exist there as well. They're just
right.
they're fundamentally different, right? We haven't
A little
seen a
bit, a little
hack.
more obscure.
We
Hmm.
haven't seen a hack of Merrill Lynch,
Right.
or Shearson, or Lehman Brothers, whatever. We've seen nefarious behavior. We've seen crooks running those hedge funds and stealing money, but we haven't seen them hacked. And I wonder if, as we get deeper into the digital era, if we'll start to see those things happen on that side or not, or if this is just really something that is fundamental to the blockchain.
So I actually expect that they probably have been hacked. with, I want to say with some regularity because they take their security very seriously. But crypto is because there's a lot of, there's a lot of poor quality projects in crypto, and these tend to be the ones that get hacked all the time. And so it's not going to be with that level of frequency. But I promise you, Merrill Lynch has been hacked, Bank of America has been hacked, and they've probably lost, millions of dollars in that process. I've got no idea what a reasonable figure would be, but they're under no obligation, I think, to report it. And there's well, in the way that it's reported in crypto, I think it might just not make the news. But yeah, like, in the early days of internet banking, for example, I was watching the interview with the hacker that discovered the bug in I want to say it was Chase, where you could send your friend a negative number, and it would transfer money from their bank account to yours. Like this is the kind of thing that that smart contracts deal with. And so there were these things, and obviously that's a relatively minor one. And he was a white hat, and I think he only took like a few dollars from his friend's bank account to just to point out that the bug existed and report it correctly.
Just to spank him a little bit.
Well, just enough to make a joke out of it, and then turn around and inform the banks that they've got a security issue. But he not everyone is as honest as that person is. But yeah, I do expect that even even the core infrastructure in finance has been exploited. And I think that the incumbency probably does what it can to, to prevent the market from panicking by keeping some of that information relatively close to his chest. And this is me speculating. Obviously, I haven't looked into this kind of thing, but I would be very, very surprised with the amount of digitization and relatively poor security practices that are already sort of widespread throughout the throughout the financial world. That if these things haven't been exploited before, I think it would be a fucking miracle.
Yeah, I agree. I agree. Hey, just a heads up that in the time that we have been on the call, we have seen some buying return from those purple and red cohorts. So we're seeing price move up a little bit at this point.
What are you seeing
I was
right
going to
now?
ask you for a little bit. Yeah, a little bit of what you're seeing right now, because we are a little bit past the hour. But if you guys both have a couple of minutes, Mark, I know you might have to cut out.
I'm going to have to wrap it here soon, but I'll show you. But I can show you real quick if you accept that in, Jen.
Yeah, for sure.
We have, we can see that they came in with more volume here, both purple and red, and have just pushed through 64K. And again, we have a history when we get around these Fed Day events, we see some volatility, and this is really clearing out the range to pave the way for that volatility to happen. This could shoot right back up here, quite conceivably. And if we have a hawkish Fed tomorrow, it could round trip the range. By the same token, if we have a dovish Fed, then we could round trip this move right back up. So, I'm going to continue to watch liquidity in the order book. As you can see, just from the beginning of the call till now, we see more bid liquidity coming in here in the sub 60K range. And if we zoom out, this could change, right? So there's that 56 to 58K level. It's really 58 to 60 that I was looking at, and that's still, to me, not really the strongest level. So this is going to change over time. The level that I want to see down here in that 44, 45K range at the moment, we don't see any real liquidity there. So there's no sentiment at this point. Maybe we'll see that change. Certainly, if price breaks through the 60K level, I think we'll start to see, we'll see bids stack around the 50 to 52. And, you know, and then maybe we get into that mid 40s range would be just tremendous. But I took a little bit on that last dip just in case, and if it you know, if it continues to climb, great. I've improved on where I sold from, so I'm happy with that. I think you're muted, Jen.
I was absolutely muted. Thank
But you
you.
know, if you want to see these moves when they're happening, so that it's actionable intel for you, you know, you need the tools, and we have extended an offer to the Carbon and Bancor community to get a discount. So if Jen, do you have that, by the way? Did I share that with you?
I don't have, you did, but I don't have it here. I was trying to share earlier and I wasn't able to.
Let me
Do
see
you
if I
have
have
yours
it.
by chance?
Let me see if I do, and I will share it real quick so that I can remember what the promo code was. Let's see. Okay, I think I can do this. All right, bear with me. Oh, that's not the one. This would be the one. All right, it's 20% off. Use promo code MICARB20, MICARB20. Let's see if I can get this slide up here for you on the screen share. I got to share something else, right? This is very complex stuff we're doing here.
And Keith, thank you for extending this offer and creating this for the Bancor and Carbon DeFi community. We speak about the tool.
This would have to be, oh, hang on a second. You know what I got to do? I got to just like make it big on the screen because we got to do this. We have to do, folks, by the way, bear with us. We have to make slides for this thing to work the way that we want it to. But I can show you real quick. Boom.
Okay.
There it is. You got to accept that one now. All right. So 20% off any plan if you want you know, this version of Fire Charts that I've been sharing with you, which is the newer version, Fire Charts 2.0 beta. Yes, it's been in beta for a long time, but we keep making improvements. So
nothing wrong with that.
Right. And that comes with a whole suite of you know, over a dozen other charts and tools. So check it out. Materialindicators.com, 20% off. Use the promo code MICARB20, MICARB 20 for 20% off.
Thank you so much, Keith. And Mark, I wanted to really quickly, because we didn't run a simulation today. We kind of went through the creating a strategy process, but for all of our audience, they can go and kind of back test a trading strategy, get to know what the capabilities are before actually creating a live strategy. carbondefi.xyz/simulate is where you can go. It's desktop only at the moment. So definitely jump on your desktop, back test a trading strategy, see what sort of results you would get. It gives a lot of the insights and the analytics there. Also, some material indicators with the order book analytics and the fire charts, and Carbon DeFi with the back testing. Thank you guys so much for joining me up here. You're both wonderful. I look forward to having you back next Tuesday. It'll be the same time, 3 p.m. UTC, and Crypto Corio will be back with us next week as well. So we'll take a look at his dashboards and see what the latest narratives are at the moment. Very
cool. Well, Mark, enjoy your time on this side of the pond.
Thank you so much, Keith. And thank you so much for joining us up here. I do thoroughly enjoy your company on these calls.
I appreciate that, and I enjoy spending time with you guys. These are always fun to do.
Thanks so much, guys, and thank you to everybody that's tuned in. We will see you next week, Tuesday, 3 p.m. UTC.
Cheers, everybody. Guys. Have a great rest of the week.
Cheers.